and the S&P 500 fighting for another record day, while the Dow is back below the 40,000 level. But our next guest sees only more gains ahead for the benchmark index, calling for the Dow Industrials to hit 60,000 by 2030. Joining us now is Ed Yardeni, Yardeni Research President. Ed, thank you for joining us here today.
Thank you.
Let me just ask you about your call here. That would be a 50% rise if the Dow went from 40,000 to 60,000. I just did the math. We went 50% in the last 4 years from 20 to 40. So there you go.
Yeah, I think the economy is performing extremely well in the face of what seem to be high interest rates. But I think increasingly it's becoming clear that interest rates are simply normalized back to where they were before the great financial crisis. And meanwhile, inflation is moderating. So I don't think that we actually need the Fed to cut interest rates for the market to continue to go up on earnings. I would prefer that it goes up on earnings rather than valuation, because valuations are already a bit stretched.
Ed, hey, it's Julie here. It's good to see you. So what convinces you, what's going to be the main sort of tailwind for the continued gains in earnings that you are expecting?
Well, I think productivity is the big story from a macroeconomic standpoint. We have a shortage of skilled workers. I think companies are seeing that their business is really quite good, even with the global economy kind of muddling along. It's not exactly booming, but U.S. companies are doing extremely well. We've got analysts raising their expectations for earnings in 2025 and 2026. And so I think companies are going to want to take advantage of the strong environment that they're seeing by increasing their productivity so they can bring their goods and services to the market. If they can do that and using technology, then I think we're going to see better than expected economic growth, lower than expected inflation, with real wages going up and expanding profit margins. So put it all together, you've got a great scenario for the market to continue to move higher.
And can you talk about some of the importance of that technology, a lot of which is based on AI, at least that's where the hype is. We've seen this play out in the chip market with NVIDIA, but we've also seen the infrastructure play, the electricity play, all these other things, copper at record highs. Where do you see that fitting in?
Well, I think all these things are, there's a lot of moving parts here. And as you just indicated, and I think that the technology revolution that started in the 1990s has evolved to the point where a lot of these technologies are very user-friendly. They're relatively affordable. They're relatively easy to operate, and they have tremendous impacts on every business. I think every business these days is a technology company. They either make technology or they use it. If you don't use technology to increase your productivity, you're going to kind of lose it. You're going to be out of business. So I think that's where the story lies, is in the productivity boom based on the productivity revolution.
Ed, what do you think is the biggest risk to further upside in the market?
Well, there's always risk, and clearly there's still plenty of geopolitical risk. Look, recessions tend to lead to bear markets, or bear markets anticipate recessions. The market didn't do a very good job of that in 2022. Expecting a recession that never happened. But usually recessions are caused by credit crunches. And at this point, I don't see something like that. But a spike in oil prices is something that, from a geopolitical perspective, is still not out of the realm of possibilities here. Fortunately, the price of oil has actually moderated quite a bit ever since Israel and Iran launched missiles at each other and then kind of backed off. So I think there's enough oil so we don't get a kind of big spike the way we had in the 1970s when we had two spikes. And now this decade, we had one in 2022. I don't think we're going to get another one, but that would be the risk.
Let me ask you about sentiment here, and we can measure that a few different ways. One way is the equity put to call ratio. I guess where I'm coming from is we see the indices at record highs right now, but we're not seeing those frothy valuations. We're not seeing the euphoria that we've seen at other extremes. So where do you see the path forward, and where do you see that euphoria and perhaps sentiment that gets too elevated? Where do you see that coming in?
Well, sentiment has been pretty flaky of late. A few weeks ago, it got really high, and then in April we had a sell-off, as you typically do when there are too many bulls and not enough bears. And then the bears came in, and now we're back to seeing a lot of bulls. But all in all, I think the market is in good shape from a fundamental perspective in terms of earnings. Valuation is definitely stretched. But all in all, with the economy doing well and the first quarter earnings season turning out to be really better than expected, I think we've got the market in still fairly good shape to make more gains.
And it's interesting to me that you're somewhat, I don't know, Fed agnostic is the right way to characterize it, but Fed agnostic when it comes to the long-term continued returns of the market. But when you watch the Fed here, what is your current thinking? Do you think we will not get an interest rate increase this year? I think the last time we talked, maybe we're still looking for one in December.
Well, they just won't listen to me. I told them to take the rest of the year off, and I haven't heard them announce that they will do that. But I don't think the economy needs rate cuts. The economy is doing fine. I don't think any rates increases either. Look, I think the economy is going to continue to grow with inflation moderating. Why mess with a good thing? Why mess with success? My concern actually is if they do come in and lower interest rates, then we'll have something more like the late 1990s, where "Party Like It's 1999" as would be the song that comes to mind. I don't want to see a melt up in the technology-led melt up the way we had in the late 1990s, followed by a tech wreck, as we all recall from what happened back then.
I don't want to see that either, but I'm all in favor of giving the Fed a few months off, maybe till the end of the year as well. Thank you, Ed, as always.
Thank you.